Welcome to The Explainer. Let's get right into it, because today we're diving into a massive strategic pivot mapped out in Crown Castle's Q2 2026 earnings report. Now, if you follow telecommunications or REITs, you already know Crown Castle is an absolute giant in the US infrastructure space. But the second quarter of 2026, well, it wasn't just another routine quarter of leasing space on cell towers. It was a defining moment of transformation. We're going to unpack exactly how a massive divestiture is fundamentally rewriting their financial narrative, totally resetting their balance sheet, and basically changing their entire trajectory for the rest of the year.
Here's our roadmap for today. 1. A strategic transformation. 2. Q2 financial results. 3. Decoding organic growth. And 4. Upgraded 2026 outlook. Let's jump in.
Part 1. A strategic transformation.
Check out the specific language CEO Chris Hellebrandt is using here. He is hyper-focused on a, quote, pure-play U.S. tower strategy. For years, Crown Castle was operating this mixed model, juggling macro cell towers right alongside a massive fiber and small cell network. But this statement, it signals a sharp, really decisive pivot. They're shedding all the complexities of the fiber business to double down on what they do best, traditional U.S. cell towers. It's a classic case of addition by subtraction. They're focusing purely on high-margin, predictable tower revenues.
So the catalyst for this pure play strategy was finalized on May 1st, 2026. Crown Castle officially closed the sale of their fiber and small cell businesses to EQT and Zio, and that resulted in a staggering $8.4 billion in net proceeds. Honestly, it's hard to overstate the magnitude of a transaction like this. It essentially flooded the company with cash while simultaneously streamlining their entire operational footprint. But as you know, the biggest question in corporate finance whenever a company gets a windfall like this is always, what are you going to do with the money?
Well, CFO Sunit Patel didn't go out and make some massive risky acquisition. Instead, he took a highly disciplined approach to rapidly deploy that cash and shore up an investment-grade balance sheet. Step 1, they wiped out over $7 billion in debt. In a macroeconomic environment where capital is expensive, taking $7 billion off your debt load is a massive de-risking maneuver. Step 2, they returned value straight to the shareholders by completing a $1 billion share repurchase. The end result? They closed out the quarter with 100% fixed-rate debt, a weighted average maturity of 7 years, and $4.5 billion in available credit. They literally built a fortress.
Part 2. Q2 financial results. Before we get into the raw data, let's just take a quick second to demystify some REIT jargon. If you look at standard net income for a tower company, it can be highly misleading. Building towers requires massive upfront capital, right? And that generates huge depreciation charges on the accounting books. But that depreciation isn't actual cash leaving the building today. That is exactly why AFFO, adjusted funds from operations, is the crucial metric we have to focus on. It strips out that non-cash depreciation and gives us a crystal clear look at the real operating cash flow they generate just by adding tenants to existing towers.
Now, if you just glanced at net income, you might actually panic a little. It plummeted from $291 million down to $94 million, which was mostly due to losses on the disposal of that fiber business. But look at the true cash flow. AFO actually increased by a very healthy 10%, jumping from $444 million up to $488 million. And this increase in true cash flow was largely fueled by significantly lower interest expenses. Remember that $7 billion debt payoff we just talked about? Plus higher interest income from holding the sale proceeds. So the core cash-generating engine, it actually got stronger, not weaker.
Part 3. Decoding organic growth.
To properly decode the underlying growth of a tower company, we have to look at a metric called organic contribution to site rental billings. You can think of this as the pure underlying heartbeat of the business. It measures the revenue growth coming strictly from new leases on existing towers, plus the built-in rent escalators in their contracts. It deliberately strips out the noise. Things like one-off cancellations, acquisitions, or sudden market shocks, giving us the true measure of their operational momentum. Breaking down this baseline growth, we can see the positive drivers really clearly. $65 million from core leasing and another $100 million from contract escalators. But there is a massive drag on the business this year, to the tune of a $240 million hit. That impact is specifically coming from Dish Network lease terminations, along with some lingering cancellations from the whole Sprint and T-Mobile merger. These are unique, isolated events, and honestly, they kind of mask the underlying strength of the core leasing activity. But when we separate that noise from the signal, the picture brightens considerably. If we just look at the baseline organic growth for Q2, it sat at 3.9%.
However, when we exclude the specific revenue drag from the DISH terminations, we see that the true underlying growth rate of their core leasing was actually a really impressive 4.2%. That is a solid jump compared to the 3.7% they saw in the same quarter last year on a comparable basis. What does that tell us? It tells us that despite some isolated customer churn, the fundamental demand for space on their towers remains incredibly robust.
Part 4. Upgraded 2026 Outlook. Driven by the operational efficiencies of finally becoming a pure-play tower company, Crown Castle has positively updated their full-year 2026 outlook literally across the board. They bumped up expected site rental revenues by $5 million due to stronger organic contributions. Even better, they expect site rental costs to drop by $10 million and SG&A expenses to drop by $15 million, partly thanks to lower stock-based compensation. Toss in a $5 million decrease in expected interest expenses, and you've got a company that is simultaneously growing its top line while aggressively trimming its operational fat.
Ultimately, these across-the-board upgrades pushed their full-year 2026 AFFO midpoint guidance up to a very healthy $1.975 billion. That's a $5 million increase from their previous guidance, and it is a crystal-clear signal that the new strategy is already paying off. They're generating more cash, they're operating way more efficiently, and they're rewarding shareholders with a sustainable dividend, all of it supported by that massive $1.97 billion cash flow projection.
Wrapping up this explainer, I want to leave you with a provocative thought. Crown Castle didn't just survive a complex quarter, they completely reinvented their financial foundation. By shedding that capital-intensive fiber business, paying down $7 billion in debt, and focusing entirely on high-margin U.S. towers, they have created an incredibly lean cash-generating machine. So, as we look toward the continued rollout of advanced wireless networks and the literally endless demand for data, how might this pure-play pivot serve as the ultimate foundation for dominating the next decade of connectivity? It is a fascinating question for anyone watching the infrastructure space. Thanks for joining me on this one, and keep learning.